Thank you very much for joining us today on the next episode of Fasanara's Digital Dividend Podcast. So we are joined today by Scott Donnelly, the head of lending for Tide. And I am Matt Coos. I'm Matt Coos, the head of origination and a partner at Fasanara Capital. And here with me, we have Nikita Segikov, a VP on our origination team. So, Scott, I gave a hint in the intro there to who you are and what you do, but could you get a little more color on what is the head of lending and who is Tide?
Sure, yeah, I'll start with Tide. So Tide's an SME financial platform. Started in the UK, I think it was around 2015. It's, you could sort of say it's a neobank, but we view it as a kind of a bigger play, more as like a sort of financial admin platform for SMEs. The main sort of idea behind Tide is, for small business owners who don't have a dedicated financial sort of team. A lot of the sort of work around that stuff is kind of just a burden. It's kind of a necessary evil, something they don't want to do. The owner of a small business is typically going to be, CEO, CFO, chief marketing officer, like all of this stuff at the same time. So the point of Tide is to sort of make the finance admin side of that as easy as possible, right? So it's really the main USP is like that it's convenient. We cover a lot of the bases. So it's the traditional banking that you would do, sort of bank account, cards, that type of thing, but also accounting, invoicing, in our case, lending as well, card acquiring. So we're moving into sort of other broader areas as well. But we've gotten quite a bit of traction. There's close to 700,000 users just in the UK now. So it's it's something like 12% of all the SMEs in the UK are using Tide, which is quite a big. When I didn't realize that when I joined, it was about a little over a year and a half ago. I knew who they were. I live outside of the UK, but I didn't realize the numbers were as big as they were. And so we opened India, which grew quite a bit over the past year. This has also reached almost 700,000 customers as well. Recently launched Germany, so that's kind of early days, been a kind of regular launch for only a couple months.
Yeah.
Looking at some other countries, but the markets we've, let's say, committed into pretty hard, which is UK and India so far, have been successes. So my role, my background, worked with some tech companies in the US. I had a master's in economics, did a lot of econometric stuff. This is I moved to Europe, I guess it was about 14, 15 years ago. And this was right when the data science stuff was taking off, right? There was no programs or anything. People just heard the words big data and said it a lot, and we need to hire data scientists. So at the time I knew how to program and I knew statistics. Mm-hmm. And usually there was kind of who knew one or the other. And I knew a bit of both. So tripped and fell into fintech on the risk side, credit scoring side, working for a fintech group in the Nordics called Multitude. Ran all the credit scoring there, around the lending. That's kind of where I learned the business, essentially, right? Kind of on the job and seeing all the nuances. And I was working on a lot of the marketing analytics and optimizations and models there too. So I ended up starting a business unit inside of the bigger company, which was focused on consumer around business lending. Ran that for a couple of years, and then was working as the head of lending at Solaris Bank in Germany, and then got headhunted by Tide and ended up joining, and that's where I am today.
Wow. Yeah. So it's quite a cool journey. It sounds like it's grounded in a background that was quantitative. You had some interesting experiences along the way, but now you've landed at, as you said, kind of the one-stop shop for financial services for SMEs. That's, again, I guess the largest provider in the UK, on the way to being one of the leading providers in India and Germany with close to 2 million customers. So that's quite a journey and, quite a respectable path forward. Could you talk maybe to, you mentioned USPs of Tide. being that you could provide a number of services to SMEs. Can you elaborate on the kind of full scope, and then also then honing in on what your specific focus is there?
Sure. Yeah. I mean, we offer the basic business account and sort of debit cards. That's the entry point for a lot of the customers when they come in. But on top of that, we've really built out quite a bit of the other features. So we have an accounting software that's obviously tightly integrated, with the BCA stuff, the bank account stuff. Invoicing, which is like very, very sort of active part of the whole thing. Card acquiring. So, this is one of the pieces that was, more recently developed, but getting some pretty good traction. So we have, card devices that we can provide, like POS, sort of for bigger stores, but also tap to pay, so that the can use their phone, because a lot of people are doing, let's say sort of coffee stand at an event, or, kind of part-time side hustle types of things. So that's perfect, for those types of businesses. So Credit Flex itself is essentially, so the lending at Tide is kind of divided into two pieces. So we had PCS, which is Tide acquired a sort of online comparison site called Funding Options. So for larger loans that are, sort of, let's say, bigger than sort of 10,000 or, longer term, 2 years, 3 years, 5 years, that type of thing. We work with partners, so people like Iwaka and others who are in the space. Sure. And then the other piece of it outside of that is TCS. So PCS is Partner Credit Services, TCS is Tide Credit Services, which is what I'm doing. That is focused on sort of providing credit ourselves, but it kind of kicks back to the main idea, which is, in Tide we have all of these different businesses: BCA, accounting, invoicing. But there's this connectivity sort of strategy and piece we're looking for, that everything works seamlessly, everything is connected to each other. So Tide TCS loans, the Credit Flex loan, which is the main product that we have, is a buy now, pay later, sort of built into the bank account, and it's sort of present in different parts of the app. So the idea mainly is just convenience, right? So we do sort of lines up to 5,000, anywhere between 2,000, 5,000. So the idea is we couldn't partner that out with anybody because it's so tightly coupled to all of the different pieces inside the app. So, I mean, the original idea was Tide wasn't going to have a balance sheet and do all the lending stuff. But then we kind of realized that the only way we could do it sort of right was to, build it ourselves and then, sort of do the lending on our side. But of course, we found external partners as well to work with in a different way. But that's the idea. So, if you look at what are the big problems for like the SMEs, right? It's liquidity crunch, right? I mean, they even sort of had this sort of fair payments code in the UK, right? I mean, it's such a big problem. Small businesses getting paid late by big businesses that it's come to the attention of the government. I mean, it seems like it's maybe not had a huge impact yet, but the general idea and shining a light on it is a thing. But small businesses are generally getting kind of the short end of the stick when they're dealing with larger partners on the invoicing side, right? So having short-term liquidity available to, sort of help with that, that's a big part of the gap, right? The ideal customer for this type of product is sort of liquidity problems, but not solvency problems. Right?
Sure.
The other piece is, some stat I saw was crazy, which is, only 5% of SMEs now have access to overdraft. Back in the 90s, it was, in the 90s, it was like 30%. Right. The product basically just did it was partly due in 2008 to the capital requirements around unfunded revolving lines and stuff. So the banks just basically bailed on the space. But so that product, which would have covered a lot of this stuff, essentially disappeared. But buy now, pay later has sort of started to step in, right, and fills similar kind of gap. It's the same idea, and I think on some level, from a risk perspective for the lender, a buy now, pay later type of product helps them in a similar way, but gives you maybe a bit tighter control on the risk. So it ends up being kind of a win-win for both sides. And that's the idea. So the idea is essentially to solve the short-term liquidity problems for the Tide borrowers. And then if they need, let's say, what would be the equivalent of CapEx or like major inventory investment or something like that, then we kind of work with partners who do larger, longer term loans to cover those.
Sure.
Scott, given that we met you, we followed the credit flex from the early inception development of the product. Looking back now to the last year, what were the biggest challenges you saw developing the product and bringing it to the market where it's actively traded now?
Yeah, I think we kind of ran it as a pilot in the beginning, and then I think it's tricky. I think one of the challenges, you're working with a sort of closed population, which is different than what I've done in the past. Like typically, like you kind of work and develop the underwriting stuff, and then like just flood the market with advertising money. So now it's really like, where do we put this into the app to make it connect, kind of organically without being spammy and without, sort of advertising it, but like finding, ways where it's not intrusive, but still visible and, getting the volumes that we want to get, the levels of sort of exposure that we need, things like that. That was definitely a totally different experience. But I mean, that's also the good thing. We have a sort of like built-in customer base, and it's fairly large, and we can get in front of them. So yeah, it was kind of learning the ropes around that piece.
I mean, in terms of launching that and getting that rollout, so you made that jump as we talked about. You had this partner credit services, so you had people looking for large loans, but now you wanted to roll out this completely new offering, help people with a liquidity crunch to solve, short-term liquidity issues by extending the term of a specific payment, right, or group of payments.
Yep.
And, what do you feel is kind of the specific USP that you're offering? Is it that it's kind of, you see it as a replacement for an overdraft line? Or do you see it as a way that some of your customers have been able to kind of use it as a replacement for an inventory finance line, or a replacement for, if they're not big enough to get a factoring line yet? How do you see people using it, and how do you see it as kind of the main pitch for why customers should take a credit flex exposure?
Yeah, the main thing, I would call it like preemptive overdraft on some level, right? So there's basically two ways you can take it. There's like pay with credit flex, so any sort of outbound. So what we do is we give people a shadow limit. They don't necessarily know what it is, but if something's happening where we would show a credit flex, and there's available space for that transaction, then the gods sort of smile upon them, and then the offer appears in the app, and then they take it. So if they're making an outbound payment within their limits, and there's some space available, it'll just say, hey, would you like, as it's about to go out, would you like to convert this into for credit flex? And it's kind of 50-50. So that's the pay with. And then cover with is, if you had a card transaction or bank transfer that you made, retroactively, you can go and do that. So yeah, that's kind of how we've put it, is, it's like, preemptive overdraft. Sure. So you don't go into negative balance in the first place. I mean, we're playing with the idea of kind of automating this and allowing a credit flex loan if someone goes into the negative balance. Mm-hmm. But we're still a little bit early days on all the risk models and stuff. So, I mean, it's it can be a double-edged sword, which is like everybody who really needs credit flex has low liquidity. Yeah. And is around. But you also have to then take that population, like some segment of that is actually pretty risky. Yeah. And some segment is less risky. So like we're still kind of learning that distinction between the two. The good news is, I mean, we have their bank account, in many cases, invoicing data, accounting data, and things to sort of really fairly assess them, right? And see what's going on in the business pretty deeply. And then, that's another one of the challenges, is like bringing all that data together in a way that's, because it's unstructured in some ways, right? In different parts of the app and different areas of the business. So we have to kind of bring it in and put it all back together and that stuff. But yeah, I think, Yeah, but the main way to think of it is like cover with and pay with, but both involve some sort of preemptive thought about trying to avoid running out of money, right? So that makes it a bit different than overdraft, but I think in terms of the purpose it serves, it's identical to what you would want out of an overdraft.
And in terms, I think it's a great way of explaining it and conceptualizing it, pay with and cover with, in terms of the uptake and utilization you've had thus far. Have you seen a material difference between the actual kind of credit flex portfolio, the amount lent thus far, in terms of the skew towards pay with, the skew towards cover with, and then if you have seen within those subsets any difference in the risk profiles?
Yeah, I mean, when I started at the company, most of it was going on the pay with, but that was because, our cover with, let's say, I don't know what you call it, marketing or however we were showing it was, let's say, suboptimal. So a lot of the work that I kind of mentioned earlier, was, kind of 6 to 9 months of like making it much more visible, making it more attractive in the ways that we showed it and stuff like that. So now it's gone to about 50-50. Haven't seen much difference in terms of the risk differences.
Okay.
But yeah, I think, the growth area really, if we're going to develop it further, is going to be the cover with, because there's more footprints in the app to do that. Like also, and if someone's like sort of sent out an invoice and they're waiting on it, we can kind of signal them that they could take previous transactions and, use it for that. So the pay with is really in the moment of sending, and that's kind of it. So probably, the future is on some level, expanding cover with as much as we can.
Okay.
Interesting, Scott. That given all those data samples and given how the UK SME market is underserved, where Tide is a clear leader, do you see, Credit Flex 2 and Credit Flex 3 or some variations of it coming up in the medium term, in the next year, maybe in the next 5 years? What's the longer term plan for the Credit Flex and the similar products?
Yeah, I mean, I think where we are now, it's basically 4-month terms up to 5,000 in the limits. There's definitely, as we develop the risk models further, probably some space to go to 6 months, go upwards on the limits. I mean, there's quite a few big companies at Tide as well that maybe don't need 5,000, but need more. As I kind of mentioned previously, like we're looking at the idea of like credit flex getting triggered in the case of like a negative balance breach.
Yeah.
For some customers. So it's not overdraft per se, but it kicks in, it creates a loan for that transaction.
Sure.
It brings you back up to positive, and you won't like necessarily be able to keep just hammering it negative constantly. Yeah. But if you run into a little trouble and you weren't preemptively doing the overdraft, we'll cover that for you. But yeah, I think this is the type of thing we need to develop the risk models a bit more. I mean, you start getting into maybe a riskier space with that. We started with you guys, I guess it was 2 months ago. So now this is the first time we're scaling up the business. We had a pilot running. We have the data from the pilot, but there's a bunch of things we didn't see in the pilot scaling up, right? I think we essentially had to throttle the business. We had a fixed amount each month we were testing with. But we haven't seen, let's say, the full customer lifetime value because we were limiting the loans, right? So we don't know what like the churn rate of existing customer, things like that are fully developed. So now we're gathering all that data very quickly, and we'll have better ideas on segmentation, customer lifetime values, and then we can kind of weigh this stuff a bit more accurately.
Well, Scott, I have to say, I think we've known each other for a while, and one of the things that I like about working with you is not only that it's clear your stuff, but you say this word a lot in your explanations, even that we've had just now. It's risk. It's your focus on risk, and it's the fact that it's clearly understood that it's a high yield product because there is risk, and everything around the risk needs to be assessed and substantiated via analysis of the data. And I think that was something that we were so impressed with within the analysis we did of the Tide Credit Facts process. And if you could maybe speak to, without, giving away your secret sauce, but kind of the elements of data analysis that you incorporate into the underwriting, into that limit setting, into the go, no go, and into the process of then pricing, that would, I think, it's something that needs to be highlighted, is all the work you did to get there. And if you could maybe speak a little to it, it would be really interesting, I think, for our audience.
Yeah, I mean, I think just the general principles of it is sort of, when you start off lending, you're in this dilemma where you don't have any data and you have to lend. So, I mean, you start with, we say expert rules, and that's, the best, you basically come in and what data do we have? And then it's pattern recognition from the past. It is on some level guessing. No one likes to hear that. But people who are outside of the lending business, you've been in this game a long time, and credit back to you. You're definitely one of the most knowledgeable people I've met in this space. And,
appreciate it.
But no one likes to hear that part of it. But there is a bit of in the beginning where you just see what happens. Hopefully not with lots of money, but you kind of you test, and then you gather, and then then you create rules. Essentially it's like a decision tree, like a very rough just decision tree. Then you get more data, and then the branches of the tree get wider and more refined, and then eventually you can make a statistical model when you have enough cases, and you can debate about what enough cases is. But the trickiest part with lending is it takes way longer than any manager who doesn't know the business wants it to take. Fortunately, our CEO has a lending background, so I'm very lucky in that respect that he understands the deal. So that helped a lot, and that was an attractive part of joining Tide for sure. And I think, but if you're trying to deal with investors or people like that and explaining to them that it takes so long, it can be tough, right?
Absolutely.
But you can get some performance, pretty early on. I mean, I'm sometimes surprised by how well the let's say common sense rule sets work, to be honest.
Sure.
And you just have to constantly be checking what's going on. But then, I mean, there's always this game of, all right, now we're going to open it up. And then, let's say there's, the total population of people, you're lending to this bit, you want to get to here. You've only seen this.
Yeah.
Maybe you have some hunches based on what you see from this, how to get to this. But once you go to here, there's a bunch of stuff that you have given this group on the outside of the frame.
Yeah.
I've never given them money before, really. So things usually go okay, and sometimes they don't. And then you have to be able. I mean, I'm a big proponent of managing by dashboard on some level. I'm kind of a technocrat on some. I just have the dashboard. Sure. Want to see what's going on with all this stuff, and that was a big chunk of the first year at Tide was getting that system set up, finding where the data. I mean, it's a lot of work. It's really a lot of work. But once it's there, you can really daily see, what's happening with, fluctuations between different segments that you're lending to and things like that. But so you kind of go to this bigger space. And then you learn from there. It probably goes a little bit wrong. Then you have to explain, all right, well, we overshot this, and then we pull it back. I mean, the endless cycle in lending is essentially sell, sell, sell. Oh, no, the behavior is getting worse. Tighten. Yeah. Oh, why aren't the sales high enough? We're not going to make the targets. Loosen. Hopefully the band narrows as you go, right? The fluctuation between the high sales and the worst payment behavior. And then it just becomes very manageable and predictable. And then eventually, I've seen after 2 years or something, you dial in your underwriting. There's refinements you can make, but, there may be kind of marginal. And then it's just plowing the marketing out there, right? Because you're pretty confident, or finding new segments, higher loans, amounts and things like that to get into. But
I mean, I think from our perspective, it was, it's the set of rules that's based on, I think, what's unique to you, and in our view is a trend that we see, rolling out across the lending industry in general, in countries where there is PSD2, is the use of bank account data, live bank account data, and the fact that you have this from your base of 700,000 SMEs who use their tied account as their current account. You have all of their incoming revenue data. You can look at seasonality of the revenue. You can look at trends in the revenue. You can look at their expense base. You can look at trends in their expense. You can validate, the strength of contracts they have all through the transaction data that you have. I mean, that I think puts you in this first place unique scenario. And then being able to supplement the actual performance and behavior data from the bank account with credit scoring and then common sense rules. It's that combination thereof, which may involve, at the end of the day, 100 rules, but all of them are conditions based on, 13 or 15 underlying concepts. And this is what we like. This is what we appreciate from your side. And I think it's going to be interesting to see as we grow, what iterations it kind of goes through and how things evolve. How much more you weight, for example, the input, which is based on, number of days that the account dropped below X, or number of days that, expenses spiked above Y. It'll be cool to see, what your end rule set is. But from your prior experience, how long did it take when you were, at a prior lender, which I considered a very successful one in the Nordics, for you to get to the very large portfolio you got to in terms of iterations? Do you remember what version the model was at the end, or how many years it took?
Yeah, it was. I mean, I think, we were, it varied by country. We were operating in 5 countries back then, but
yeah.
I think it was about a year to get to okay, it's working pretty good. Let's scale it up. And then basically to the point where it was running on autopilot, and didn't feel like there was huge improvements to make anymore. Was probably after 2 years. I'd say that after that, 85% of my day was trying to figure out how to optimize Google AdWords ads and argue with brokers and comparison sites why their commissions are so goddamn high, and and all this stuff. But it was basically marketing, right? That was the headache, and just trying to get that down. But I'd say it was about 2 years, and
okay,
yeah. But was profitable and making money, from a year, let's say. Yeah.
Okay.
But then we kind of entered new countries, and then you start the whole phase over. And then the data differences between countries can be quite big in the quality. So then some are harder than others, for sure.
Absolutely.
And Scott, looking back again for the last year and a half at Tide, what is the biggest achievement you want to highlight? You assembled a great team of individuals. You launched a new product. This is an achievement on its own. But any other achievements you want to bring, to public?
It's not sexy at all, but I think, one of the things was just getting this sort of managed by dashboard system type of thing set up. Mm-hmm. It's a big one. It's a big task. There's the databases and the data teams, and there's actually, separate teams you have to work with, and putting it all together and getting it visualized, and then finding out it's broken after you've been looking at it for 3 months, and going through the whole thing. But now I feel like we're in a position where if something goes wrong, we see it. It's happened kind of, on a small level a few times already, where we just catch it very quickly, figured out, diagnosed the problem very quickly, and then make the changes that we needed to make, right? The ability to do that, then everything going forward gets not easy, but kind of reliable, right?
And
there's not chaos. Even though there's randomness in the business, naturally, it doesn't feel chaotic like that.
We see it firsthand, given the strength of our partnership, how quickly you adjust, the model and, the tweaks. So it's impressive.
And again, I think, again, it's something you're saying now that I really want to emphasize for everybody listening who's, running a lender, building a lender, invests in lending, which is the importance of monitoring and the importance of building an effective system. For you, it's dashboarding, if it's daily reports, if it's trigger alerts, but it's knowing first and foremost, what are the things you need to monitor? And number two, setting up a methodology that allows you to monitor it on a live basis, because I can't tell you enough, which may be mind blowing to some people to hear, but I can't tell you how many lenders come to us and they say, I've done 2 years of lending, or I've done 3 years of lending. And then it takes them a month and a half to generate a loan tape. And then I say, how can you not generate a loan tape? How are you monitoring the portfolio? And they say, well, we look at the cash flow in. And this is like, I'm floored, because it's like, you can't tell me, what is the delinquency rate? What is the roll to default rate? What is the cure rate? How are things going? So monitoring is the key. If you can't monitor, you can't tell me if it's working or not. So very, very glad to, again, see the importance on the Tide side.
Yeah, I mean, it's stuff that I learned at my first kind of job doing the data science stuff. But I mean, yeah, hey, you've been around for a while. I mean, maybe I shouldn't talk trash talk, but it's like, there's a lot of people who are smart people who came in from, big tech, consulting, investment banking, good background, smart people, but never lent money.
Yeah.
And then, sort of raised money and hadn't learned the fundamentals of the business, and they think of it like a subscription business or something like this.
Yeah.
And it's a lot more unforgiving than that is, right? I mean, you can go south pretty quickly. So I mean, there's like some fundamentals you definitely have to, and it really comes down to on exactly what you said, which is knowing what to look at and when to like pull back when you see the signs. I mean, just monitoring your, depends on the length of the loan. This changes, but just monitoring the number of late first payments,
Yeah.
like that's one of the best early indicators there is. Like if you track this every month and it spikes, something went wrong last month. You know it already. You don't know how wrong it went, but something went wrong. And then you start trying to scramble and figure out what the hell is going on. And a lot of times, it's not as bad as you thought it would be or something like that. But like you at least kind of, it's on your radar that something's off, and then you can react quickly, right? So then maybe pull back on your marketing for a bit and see what happens.
Well, I have to say, I think we've talked about a number of lessons, kind of lessons learned. We've talked about a number of findings and best practices, from, approach to credit scoring, underwriting, to the importance of monitoring, to the importance of also giving yourself time to test on smaller populations and build up over prudently. If you had to hammer it down to one thing that you could say to someone starting a lender tomorrow, or who just, met a billionaire uncle who said, you can do whatever you want, and they said, I want to start a lending business, what's the one biggest lesson you would give them?
Oh, yeah. That's a tough one. I mean, I think know your geography, like where you are. I mean, in Europe, this is more of a thing, but, some countries are easier than others if you're working in Europe. In America, it's, a different animal. But, I would say I honestly learn some basic. I mean, if you don't have it under your pocket, like understand all of the analytics and the metrics. Just understand what they are, why they're measured, and how they work, and the logic behind them. Be able to sort of calculate this stuff yourself. I mean, you have to be able to like think in those terms all the time, right? And understand I mean, in the end, it's not a lot of it. It's not that complicated. It's 8th grade math, essentially. It's algebra.
Exactly.
It's mostly ratios and understanding weighted averages and this type of thing. But it's not calculus.
Yeah.
Okay, if you get into scoring, credit scoring, and stuff like that, fine. But there's a kind of intuition you develop about these different ratios and how the things are moving. It's like a machine, right?
Yeah.
This thing moves, that thing will move, and we can pull the lever on this, and you kind of have to have a feel for this, like almost like it's a physical machine on some level, how it's all working together. Absolutely. And you'll develop that, but understanding the different levers and all the things you can pull has to do with essentially the ratios and the different KPIs around the lending business, right? So.
Clear.
No, definitely. Look, Scott, it's great working with you and your team, and we as a lender learning the space with you and looking forward to grow it. And it's interesting every time I take a tube in the morning. We see Tide advertising everywhere, but can you recommend small businesses where they can find the credit flex and how they can find you? Given that maybe sometimes they don't have even time to take a tube in the mornings, they're so busy running their own business, right? So
I mean, if you're in the UK, just type Tide Bank, and I'm sure we'll come up. Once you have a BCA account, like a bank account, then we have some criteria. The business has to be a little bit old, not brand new. It has to be older than a year and things like this to qualify for it. But once you qualify for it, like I said, if you're eligible, then the Tide deities will smile down upon you and offer it. So we actually don't take applications for the product. We essentially, it's another thing that's a little bit different than the traditional thing is we have this algorithm running in the background constantly to see who's eligible, and then we show it to them. So the good thing about it is there's no application. If you get offered it, like you just click a button and you take the loan.
Sure.
There's no hassles, no wait, no anything. It happens immediately. So yeah, that's the idea.
Okay. Well, Scott, thank you very much for taking the time to speak with us. Again, I think a lot of very practical and useful knowledge captured in this quick discussion. And as Nikita highlighted, we look forward to growing our exposure with you and working together to expand the scope of Credit Flex and the reach of Credit Flex across the UK and beyond for years to come. So thank you so much, Scott.
Thank you, Scott.
Yeah, thank you.